It is FOMC day, the day that every crypto holder looks forward to every single month, or sometimes we have to take months off and we look forward to the next one. It's the most important FOMC meeting we have ever had until the next one. And the reality is today is not going to be a day. If you came in here looking for rate cuts, technically we do not know what the answer is going to be for about 10 minutes, but I'll go ahead and spoil it for you. We're not cutting rates this time. That's not the reason you should be watching today. We will be covering the press conference at 2:30 with Jerome Powell live. And even though at the moment, I think a lot of people are expecting him to continue his rhetoric from past meetings where he's kind of, pessimistic. He keeps using the words uncertainty. We don't know what's going to happen with tariffs. We don't know. This time he's going to have to probably talk about war. There's actually a reason to believe that something bullish could happen in today's press conference. So you're going to want to stick around all the way till the end. We'll be covering the news, we'll cover the charts, and then we will watch the press conference live with you guys and analyze what does this mean for your crypto bags. Of course, in the discussion section, we're also going to be discussing in depth our thoughts on what is happening right now in the Middle East. How will war affect the crypto markets? And what will America end up doing in all of that? Stick around till the end. Make sure if you guys do enjoy the show, you love the Investing Bros, smash the like button and make sure you are subscribed to the channel so you don't miss any of our content coming out every single day. All right, let's go. Welcome. It is me. It is Tshroom. Smay is not here today. I do believe Smay became an uncle for the first time last week and has another brother and sister-in-law that came from out of town. So he has the week off. One of the most fun weeks in crypto, and Smay has the week off. But he's doing good. He will be back with us next week. So for everyone who's going to ask, where is Smay? That is where he is. I am pleased to be joined by Tshroom, all the way out there in my former home up there in Atlanta, Georgia. Tshroom, how are you doing today, my friend?
Well, it is a bit of a crazy week here in crypto, and I'm doing better than I deserve. Every week's a crazy week, though, it seems.
It's true. Yeah, I'll be very honest. As bullish as I remained about the long-term future, you see these messages either in comment sections below the videos, some in our Discord, some over on X. People are saying this is the worst, the most boring bull market ever. I don't necessarily think it's the worst. It is boring, and it seems like we just can't catch a break. I mean, heck, we told you over a year ago on this channel that I believed the 4-year cycle was dead and gone. I did think that this was going to be different, but man, there's a part of me that was hoping the different would be maybe more bullish. And again, it's not been crazy bearish unless there's certain altcoins that have been that way, but I'm feeling it. If anyone wonders how we're able to create content on the daily basis and stay so optimistic and hopeful, it's because I am playing the long game, right? I'm not investing to make money by the end of the week. I'm making money to change my life forever. But I have that feeling inside of my gut, just like the rest of you, that's like, come on. Like, why can't we catch an actual rally? Why is the minute that anything good seems to happen for us, something else has to swoop in and rain on our parade? So if you're feeling that right now, if you're confused and you're just like, what the heck? I thought we were supposed to make a lot of money. What's going on? You're not alone. I feel that way. Tshroom, do you get those feelings from time to time?
Absolutely. I was actually sharing in our morning news session that we have every day in the Discord channel that we are actually up, I think it was 330% since the bear market in the total market cap of crypto. That includes Bitcoin. So we have had triple 100-digit gains since the bear market of 2023 when Bitcoin was at 15,700. So, those of us who've been around and invested that long, we've done pretty well. But if you've bought in at any time in crypto, on the crypto side in 2024 or 2025, you may be at a loss. And, it does suck. But at least you know now more about the technology and kind of the also the waves and the cycles of investment to be able to have a better outcome in the future.
Yeah, and it's one of those things, as Tshroom said. If some of you guys, depending on when you first got in, if you have only been investing in cryptocurrency for a year or less time than a year, drop a 1 in chat. You guys are probably the ones most frustrated. Anyone who's been around for a couple of years, if you've been holding the whole time, you're wanting to make more money than you currently are, but you're excited. Your bags are up. But I definitely feel that frustration. The good news is with us. You might be saying, Tim, how are you stay so joyful? Well, guess what? While I have a big long-term bag and I'm still holding on hope that that's going to have a raging bull market and make me a lot of money, these are the days where being a day trader isn't necessarily terrible. We can make money if the markets go up, if they go down. Today's a little chaotic. I did stay out of trading for today. People within our VIP trading group were trading over there, though. But I decided to refrain from entering today because of the chaos of FOMC. But tomorrow, when we have some sort of understanding about what the market's going to look like, I'm going to go right back in. And I'm going to look at the charts. And when the charts say to long, I'm going to enter a long position. So when the charts say to short, I'm going to enter short positions. I'm going to take all that money and I'm going to buy every dip that I can because, again, I still believe if you're patient and you're waiting for it, I still believe a bull market's coming. I still believe generational wealth is coming. I know it doesn't feel great out there. I know the charts don't always feel fun to look at. But again, get into day trading. I encourage you, learn how to day trade, and it makes waiting that much more sweeter. It makes it bearable because you can make money along the way. Guys, if you are just joining us, thank you so much for being here. We will be watching here in about 24 minutes. We're going to be watching Jerome Powell live here in about 4 minutes, actually 3 minutes now. We're going to give you the exact number on what happens with rate cuts or the lack thereof, which, by the way, is realistically what's going to happen there. Would you mind turning that music down there, Tshroom? Here's what I will say, though. There's a couple investments that people, if you were invested in, if you've been invested a year or less, you've been doing well with these investments. And I know we're a crypto channel. I know we like to focus there, but let's go take a look over here. Gold, if you guys are invested in gold continues to just rip to the upside here. We are back up to almost $3,400 here today in gold. Look at that chart dating back to last year. Go back to June 2024. Gold was trading at $2,200 roughly per ounce. Today it's up over $1,000 more. Not a 2x, but that's a good investment right there. How about silver? Silver's been the one kind of making a splash here more recently. Silver's up pretty big. If you go back to this dip we had back in April, when everything seemed to dip back in April during the scares, silver's up 34% since that time period right there. And if you're sitting here saying, man, while I'm waiting for crypto to take back off, I would love to hold gold and silver. We got a good news for you. Time period right there. Playing with some sound stuff over there. If you guys are looking for a place to hold gold and silver, we got this new sponsor right here above my head. Where is it? Oh, gotta go this way. Kinesis. Oh, where's my finger? Kinesis right there. This is a brand new exchange, but one of the things that they do best is this is the only place that you can actually buy digital gold and digital silver that is 100% backed by physical gold and physical silver. I know there's a lot of places out there that say you can buy gold and buy silver digitally, but the reality is you're just buying some sort of futures account. You're just buying a coin. This is the only place, Kinesis, where you can do that. Absolutely, you can actually own gold and silver, and have the physical backing right there. Also, by the way, you can buy several cryptocurrencies, and the fees are less than half, or more than half, I should say, less than half of the fees you get over on places like Coinbase or Binance. The lowest fees in the game. Go start using Kinesis today, right now. Link down below. Check them out. Real quickly before we go to my screen, let's go back to our split screen here, Tshroom, because we're about a minute out. How are the buttons treating you over there? I know you're getting used to it again. You don't have to hit as many buttons as you used to because Smay has taken over that job. You feel good? A lot of sound going on in the background over there.
Well, I'm better than I deserve, Tim. We're having fun. We're shucking and we're jiving, and yeah, it's going to be good. I've got the live stream pulled up. Jerome Powell won't be live until 2:30 Eastern Standard Time, but we should have the decision actually here right now. It should be live.
Yeah, it's probably loading. I think we have about 30 seconds. No, there we go. It just went live now. Again, I will be shocked if this number is not 4.5. You can go to my screen if you want to. It's going to be loading up on my screen here. T-shirt. There you go. It's loading. It's not coming through just yet. Give it 1 second here, everybody. But again, there we go. 4.5. as it was previously, as it was expected. I think that a lot of these places had like 99.8% probabilities that it was going to stay paused. So we are not shocked whatsoever about this result staying at 4.5%. Okay. Again, if you were tuning in because you thought there was a chance we were getting a rate cut, sorry to disappoint you, but you shouldn't have had that expectation. The reality is that you should be listening to the show and sticking around for about the next hour and some change, because the press conference from Jerome Powell has always been the real meat. I mean, we've had press conferences before just to set the stage where we got a rate cut. So again, super bullish. You got liquidity coming to space. But then in the press conference itself, Jerome Powell comes across quite hawkish. And after the markets start moving bullishly, they end up coming back down. Why? Yeah. Because even though the numbers of what we're doing is important, what's even more important is looking to the future and what Jerome Powell and the rest of the Fed is thinking. And the reason why I think we should have some optimism, and we're looking at charts here in just a couple of seconds. So anyone is sitting here saying, Tim, go look at the charts. What's the price doing? We're going to get there in a second. The reason why you should be thinking potentially optimistic is despite the fact that Jerome Powell has remained paused for a while, there are some things in the economy that would potentially make him lean towards giving us an edge that rate cuts are coming later. Number one, inflation remains at lower levels. Inflation just does not seem to be getting out of control. And even though Jerome Powell has claimed the words uncertainty in the past, speaking about the future of inflation, mostly because of tariffs, in recent days, we've made a lot of closed deals, or we're getting close to closing deals with almost every major country out there. We've closed a deal with China. I believe we've closed a deal already with the UK. We're very close to deals with Canada, Mexico, India, and several others. And so if you start to remove the tariff fears and tariff concerns, Jerome Powell is going to lose his footing for why he's able to keep rates paused for so much longer, because that uncertainty word starts to go out the window. What we have seen is a little bit of a growing unrest about the job market, right? So even though the job unemployment levels have not skyrocketed yet, if you read the signs and you think about the uncertainty of the future, which has been on Jerome Powell's mind here more recently, one can only imagine, with inflation seemingly almost under control, at least for the moment, it looks like the job market is the one that is a little scarier. And one of the ways you can prevent the job market from getting out of hand is by cutting rates. So how will Jerome Powell answer questions about the current inflation rate, what the tariff deals are looking like, and what future unemployment seems like? Will he give us an idea that potentially July could see the first interest rate cut of 2025? Now, of course, all this is going to be muddied by events that happened over the last week, as Israel and Iran are in a all-out war at the moment. How long that war will last? Well, that's something we're going to discuss here in a little bit. And the reality is we don't know the answer to that question either, just like the rest of you, but we're going to speculate. And what will Jerome Powell say about war, and how does that really affect markets going forward? We're going to come back, Tshroom, and talk about that here in just a little bit. Let's do a check-in on what's going on majorly on the charts in the world of crypto. The first thing I want to do, I always want to start off with this whenever we have these days of concern, of doubt. I mean, even right now, Bitcoin Fear and Greed Index, if you guys did not know, is back down to neutral, back at a 52. We haven't been back in the neutral for a couple of weeks now. You'd have to go back to June 7th, all right? And if you go back to June 7th, what was happening on June 7th? Well, that was days. And if I go back, let's go to the hourly chart here. June 7th was a day we had a major dip. It's shortly after, June 5th, but a major dip down with a fight breaking out between Donald Trump and Elon Musk. A lot of people very pessimistic at these levels. And sure enough, we shot back to the upside. So at the moment, this actually is a positive sign right here that we're back down to low levels, levels we haven't seen in quite some time. But it is reflecting that right now there's a lot of unrest in the crypto markets. People are concerned about recent price movement. I just want to make sure you're aware of this. Let's just zoom out for a second. Let's just take a break from looking at the 1 hour chart and look at the daily zoomed out chart, or even the weekly zoomed out chart. It's not that bad, right? Anyone trying to tell you we're in a full-blown bear market, you've lost so much money over the last couple of days. This is a blip. In the grand scheme of things, this is a blip. And even though there's no guarantee we maintain this, If you are a fan of the model, the M2 money supply model, I need to show you that one again. It's a model that we usually see Bitcoin following with a 90-day delay, the M2 money supply. If that was the case, well, guess what? The M2 money supply actually kind of predicted a small price pullback during this time, but it would say here in the next couple of days, another big rally should begin. So if you're a fan of the M2 money supply, if you think that's something that we're going to continue with, and you can see the price similarities between Bitcoin and this delayed M2 money supply, it's uncanny. It would predict that another big move for Bitcoin and crypto should be coming soon. But with that said, let's just analyze what Bitcoin actually is doing on some lower time frames. Some things to be aware of that I am tracking. A week and some change ago, we talked about the falling channel that Bitcoin is in and how bullish it would be to break to the upside. And we even told you guys, watch out for around $110,000 as a target. Guess where we rejected almost perfectly after the breakout above the resistance of that falling channel? It was right to about 110,000. We went to 110.6, right, was the top of this movement. But we then retraced back here later in June, and we pulled back and touched the former resistance line with support perfectly. Yes, guess what? That's the night that Israel first bombed Iran. That candle turned former resistance into support, and we began to go back up. Now, here more recently, as things have heated up and there's debate and questions about if America is going to get involved, yes, Bitcoin has begun to slump back once again. Even today, we've come back down as low as 103,500. But again, this is also the FOMC day, and everyone's going to make you think everything's all about Israel-Iran right now, and it's going to have a major factor. But so is the future of the American economy, what liquidity will look like. And what we know about FOMC days, if we know nothing else, it's that volatility always seems to be king ahead of FOMC days. And it's most often the misdirective move that comes in first. If you don't take my word for it, it's okay. Go do your own research. If you go back to almost every single FOMC day, we usually are heading in a certain direction going into the day and reverse and go to the upside. Not 100% of the time, but more often than not, if you're bearish going into FOMC day, for some reason, you usually finish going bullish out of it. If you're bullish going into it, you usually go bearish out of it. So there's a lot of reasons right now, in my personal opinion, based on fear and greed index from the Bitcoin fear and greed, from things that I think could potentially be discussed today in the meetings, but also what I'm seeing on the charts themselves. I believe a misdirection could be on the table. Don't go and enter your longs right now. I'm not telling you it's a guarantee home run slice to long Bitcoin, but I'm saying if you ask me right now to make a prediction on which way the markets go over the next 24 hours, I'm going to start right now. Before hearing Jerome Powell speak, I'm going to start with a prediction. I think we end up breaking bullishly after this meeting. Now, Tshroom, I want to throw it to you before we get into some news, and then we'll do more charts here later on. We'll probably even answer some questions before the press conference, so you guys can ask questions. If there's a certain coin you guys want to take a look at, we can analyze, go for it. I'd be more than happy to look at stuff with you. But what's your take right now? If you had to bet right now, again, with what we know, don't try to, don't say, oh, it depends on if Jerome Powell. No. With what we know right now, how will Bitcoin and crypto prices respond to this press conference this afternoon, in your opinion?
Well, I mean, my opinion is that we should actually see a bid from this, because the market at the end of the day wants certainty. It got a lot of that with the rate decision just being public. Right now, there's 0% chance that it's anything but a pause. However, there's a lot of granularity, not only with what is going to be said in the press conference, but also with this. Let's turn our focus here to the statement that was put out here. Zero Hedge already has highlighted what was changed. This is something we look at often because this is what was changed in their official statement. So before we even read it, we'll read the economic outlook has diminished but remains elevated from increased further. So that, again, this is very, very nerdy stuff here, we admit, but this is what has been changed about the statement. The economic outlook has diminished but remains elevated from, so that is what it was changed to, from increased further. Okay. And then the second one is scraps stagflation warning line that risks of higher unemployment and higher inflation have risen. So those two that entire statement has just been totally marked out here, as you can see in red. Overall, this doesn't signal a whole lot to me. other
Mm-hmm.
than, they're ruling out stagflation. That's pretty good, but that's kind of baked in to some extent. So my opinion based off of this is that it's going to be a lot more of the same of last meeting, because they haven't really changed a whole lot here about the statement. Maybe I will take those words back by the end of the press conference. But again, just judging by the very little modification that's been made to their statement here, the FOMC statement, I think it's going to be the same of what we saw at the last decision in May. And what is it? Jerome Powell is going to do what he does best, is play it right down the middle and answer every question with, we're going to follow the data. And if he gets asked something about getting fired, he's going to just be very strict and direct and say, no, Trump does not have the power to fire me. I'm sure those questions will come today. I'm sure he'll also get questions about the conflict in the Middle East between Israel and Iran. And I think he'll do what he probably ought to do and what he's done in the past.
Mm-hmm.
And he'll say maybe a very short statement, but mostly say, I'm not going to comment on that. That's not our place to comment. And he'll also be asked about oil prices, and he'll say the same thing. It's not our place to comment on oil prices, even though it may have an effect on inflation. It's just that's not his game, right? It's not really the government's game either. But we do have a strategic oil reserve that was most famously used by the previous administration, but could be potentially leveraged here in case the oil prices starts to run away. Overall, I think it's going to be pretty much the same as in May. And a deviation from that, the market may not have priced in. So I will be listening very intently to see if Jerome does go a little bit off step of that normal, right in the middle, playing the fence. We're going to follow the data. Any hesitation or left or right swerve from that type of messaging could lead to some volatility, could lead to a market reaction that could be quite significant.
Yeah, I don't want to overlook the importance of the tweet that you read there, Tshroom, because it's very important, because it's very clear, that concept of him saying, it's diminished but remains elevated. What does that mean? Well, on paper, the economy was doing so well, even during the Biden administration, right? You can complain about this, you can complain about that. Heck, on paper, which is all Jerome Powell and the Fed really want to look at for the most part, the economy was extremely strong. And so when he says, okay, it's diminished, it's down from an extremely high, but it's still elevated, right? It's still at a level where things are looking good. The biggest, I think, bullish thing about this line, Tshroom, is where it's scrapping the line of the fear of stagflation. And let's just be very real, because stagflation is, of course, when you have both elevated unemployment and inflation, which at the moment, by the way, both are extremely low. Inflation didn't quite hit the 2% target that Jerome Powell's been talking about now for multiple years, but it's gotten very, very close. Correct me if I'm wrong, Tshroom, but I think it's been as low as 2.3%, which is very good, considering that a little over a year ago, we were over 4%. We got over 5% at one point, didn't we, Tshroom?
I'm going to pull it up right now, and we'll be able to see that. The headline inflation, at least. Oh, goodness gracious.
Either way, as you kind of look through that, the importance of what I'm looking at here is last month there was lines about worry of stagflation. And this happens as inflation has kind of been neutral and unemployment slowly starting to increase, but it's not getting out of control. If all of a sudden they're no longer, if they're scrapping that line that we're worried about stagflation, logically, you can't say that they're scrapping that line because they're not worried about unemployment. I mean, I was reading something today. College graduates that are between ages 22 to 25 are struggling like never before to find jobs, right? The unemployment levels aren't out of control at the moment because there's a lot of dynamics going into that. But young people are vocalizing and showing they're struggling to get jobs. If you were looking at inflation versus unemployment right now, the much larger concern would be what's going to happen to unemployment. So the only reason you're removing the fear of stagflation is if all of a sudden something has changed to where inflation isn't necessarily your concern, because it would just be completely and totally intellectually dishonest to say you have no concerns and no fears about the future of unemployment. That's just irresponsible. I don't think Jerome Powell would do that. I think this is a statement that they are less concerned with the future of inflation today than they were a month ago, and that's a major win. Now, I saw a comment in chat here, Tshroom, and this is going to kind of transition us into, obviously, the big story. I mean, you guys are coming in here to listen about FOMC. You guys want to hear what Jerome Powell says, but let's not beat around the bush. Let's not kid ourselves. The top story in the world right now, and that everyone is watching and waiting in anticipation to see how it works out, is what the heck is going on between Israel and Iran? Will the United States be involved? What will happen to oil prices? I saw in comments earlier that if oil skyrockets, that'll cause inflation. And that's a logically solid statement. Why? Because oil prices work into everything. I mean, you might be saying, Tim, what does oil have to do with my bananas? How do you think those bananas are getting to your store? They're getting there on a truck that came from a train that got off a boat that all operate with oil until Elon Musk gets every vehicle on the planet working with Teslas and electric. My point is, oil will cause inflation. So anyone saying if oil skyrockets, inflation will skyrocket as well, astute observation. Mathematically, you are on it. Here's my only dilemma with that statement. Oil is not skyrocketing. Let's go to the oil chart here. And this is something we're following here. If I can find the oil chart, I got to scroll up here a little bit. There we go. I was still looking at silver there. On the night that we had Israel first attack Iran back here on the 12th, you can see that oil prices did shoot from a measly, the day before, they were only down at $66 a barrel. It shot all the way up to $78 a barrel in a very short amount of time and then started to cool it back off. But then since then, while we have moved back up above 70, we got above 70, cooled off back to 68, and now we're kind of hovering around 73, 72 for the last day and some change. If there's an immense fear that this war is going to last for quite some time and that America is going to, in fact, get involved, why are people not going ahead right now and pricing this into oil prices? They're not going to wait for something to happen to then raise the price of oil. Look at any stock, any asset. If a Bitcoin ETF, when the Bitcoin ETF was coming way back in early 2024, they didn't wait until the day the SEC approved it to pump Bitcoin. No, Bitcoin pumped for weeks and months ahead of it in anticipation. When we thought that a rate hike was coming way back in 2022, prices in the stock market in Bitcoin, they didn't wait until Jerome Powell announced a rate hike. They went ahead and cut and dropped prices early in anticipation. So right now, we're sitting with the only thing we can have right now, anticipation. We're trying to predict what will happen in the Middle East. And at the moment, people trading the oil charts, they're not rushing to go buy up oil in bulk as much as possible for fear of the price skyrocketing. They're kind of just letting it mellow out at this level here on $73, $72 a barrel. I mean, these are price levels that we had back here as recently as February. In fact, we haven't even hit a new yearly high. The highest level of oil was back on January 16th. We had $80 a barrel. And so anyone saying oil's going out of control, oil's not even back to the highs of this year. And yet people are freaking out as if oil was already up above $100 per barrel. It easily could get up there. I don't want to sit here and tell you guys there's no possible way oil gets over $100 and then inflation doesn't go up. What I'm trying to get you at is calming anyone down before they let their anxiety get the better of them. More often than not, if something truly terrible was going to happen and was a certainty, the prices would already be reacting. And yet, at the moment, they're not. So for anyone to say, I predict inflation is about to get out of control because oil prices are going crazy, well, in that case, you're not making a prediction based off of reality. You're making one prediction off of another prediction. Because right now, oil is not out of control. And I like to be an optimist, right? I like to live in the world of reality too. But if you're telling me between being pessimistic and being optimistic, I lean optimistic. I encourage everyone to be this way. If you just think pessimistically about everything, if you're just convinced that your life is the worst life ever, that is going to become your reality. But when you live in a life of positivity, of optimism, you can be surprised at how good things actually can come out. I'm optimistic, and I'm optimistically still believing some sort of resolution will come to the Middle East friction, and oil will stay low, inflation will stay low. We're going to be okay. The bull market will take off once again. It's just going to take longer than we originally thought. That's the boat that I'm in right now. But for more on that, I want to throw it over to Tshroom, and let's get into some details. Hopefully everybody watching right now is aware of the conflict in the Middle East. So I hope we don't have to set groundwork for what's going on here, but maybe let's catch people up to date on some things that are pressing today. Where are we in this conflict? Is there reason for hope? Are we in a really bad situation right now? What's going on right now? Give us some updates, Tshroom.
Yeah, well, as the resident war correspondent here, I will
Yeah.
gladly do that. No, of course, this is going to be the millionth time you've heard somebody say that they are not a Middle East expert, and so I'm not a Middle East expert, but I've been paying attention, right? Because that's ultimately what my job is, to try to pay attention what is going to happen with these markets. It is very simple what is going on at this point in time. There is a regime known as the Iranian regime, and
Mhm.
it is led by a supreme leader, Khomeini, right? And this is an individual who is essentially backed into a corner, at least by my analysis. And the rhetoric that is being projected by the supreme leader Khomeini it looks like mostly for the population of Iran, to prevent them from uh, taking the current regime into not being the current regime, right? You can interpret
Mhm.
that however you'd like, but that is the number one priority for the supreme leader, according to what he is tweeting, what he is saying, what reporters are saying that he's saying. Is it seems like that is the most important thing, is to not lose the faith of the people, the population of the country of Iran. Which I believe is around 90 million people currently live in Iran. That number may be lower after U.S. President Donald Trump called for the evacuation of Tehran.
Mhm.
Okay, so that is the number one important thing, is to realize that the Iranian regime really sees themselves as kind of in the final hour, and that they need to get the buy-in from the people to not overthrow the regime. Now you can comment on that, you can disagree. I could definitely be interpreting it incorrectly, right? Because there is such a thing called the fog of war, right? I only know what is
Mhm.
making it, what the information that is making it to Atlanta, Georgia, right, over the internet, right? Okay, so the other important angle on this is U.S. involvement in the Israeli attacks on Iran. That is what has put Khomeini, the supreme leader of Iran, into this situation where he's kind of backed against a wall, cornered, so to speak, to where he has to do what he's doing now, which is appeal to the population of Iran, not to overthrow the
Right.
Iranian regime. We do not know. That is kind of the most up to date data. We do not really know. The public is. It's not. It seems not to be in the interest of the current U.S. administration for anyone to know how involved the U.S. is in the Israeli
Yeah.
operation in Iran. Meaning, we don't know if the U.S. is giving intel, if they are in live time supplying missiles. We don't know the extent to which the U.S. is involved. Right? There's another actor in this, which is Russia, who has been pretty quiet until today, saying, essentially that it would be unfavorable for the U.S. to show that they are supporting Israel in
Mhm.
this. So that's kind of where we're all at. It really comes down to Donald Trump's calculation. Can he win the midterms? Can the GOP win the midterms? There's still a chance that the Republican Party and the Trump administration can see their agenda through the full 4 years, or will they get a lame duck president? Is that going to happen if they kind of reveal or make the public decision to support Israel in delivering the final death blow to the state of Iran and the Iranian regime's nuclear capacity and nuclear development aspirations? So I said a lot. There's a lot
Yeah.
to say. I haven't said enough, and what I will say to disclaim is, because of the fog of war, everything that I just said is probably only 60% accurate, right? But after following this very closely, identifying the best channels of information, it really comes down to, does Donald Trump think that he can still have a victory in the midterms and in 2028 if he supplies a specific type of bunker buster in order to remove the possibility of nuclear development from
Yeah.
Iran? So maybe you can disagree. Maybe you can interpret these things differently. Today we're definitely interested in the FOMC conference. That's what we're going to be projecting live here in about 6 minutes. But Tim, what are
Mhm.
your thoughts on where we are with that conflict?
Yeah. I think I want to speak because everything you just said is it's true. It's right on. I think you said what you need to say. I want to speak a little bit more towards the fears and concerns that people will have. Fears, frustrations, splitting divides. I mean, if you are a leftist, right? If you were an anti-Trump voter, because I don't know how many people actually were strong Kamala Harris voters. I call them anti-Trump voters, right? You might be loving this, right? You saw, of course, weeks ago a split between two very hated people. If you're a Democrat, Elon Musk. You didn't vote for him, and yet he was the working president in a lot of your minds. And then you have Donald Trump, of course, and you were never Trumper, right? You see a split in their relationship. And a lot of Democrats are sitting back just eating the popcorn, right? And then that gets mended. It's like, crap. All right, well, that's what we thought it was. Now you're watching, of course, if you guys have not been paying attention, there's a rift between Donald Trump and Tucker Carlson. There's a rift between Donald Trump and actually several Americans, and there's this split going on amongst, and I'm not going to even just say conservative Americans. I think even within the left, I think there's a split right down in America. Some Americans are very anti-America go to war. We fell for the lies back in the early 2000s when we were told that Iraq had weapons of mass destruction. We don't want to repeat those same mistakes and go back to a war once again. But other Americans will tell you, no, there's no way Iran can have nuclear weapons. We trust the information that's being told to us on the television. We need to go to war, yada, yada. Here's the reality is I find myself on the side, if I'm being very honest with you guys, on I do not want America involved in the war. I'm not going to ask a poll for you guys to vocalize your things. Ultimately, if you think we should go to war, I'm sure you have in your mind very good reasons. I respect your reasons, your opinions, your thoughts. I just happen to differ from them. So you're going to sit here and say, well, Tim, if you have that opinion, are you upset with Donald Trump right now about what is going on? And the fact is, I might be. I don't know. Because as Tshroom pointed out, the fog of war, that's going to make so much information hard to truly understand what's happening. The reality is, I want you guys to think critically with me. The reality is, whether Trump is thinking he wants to send America to war or not, he can't let Iran or the public know his true intentions. Because if he actually lets you know what he's really thinking, then you could make educated decisions if you're Iran based off of that. What I'm truly hoping, and I think is a reality, is if war is this big red button sitting on the desk at the Oval Office, and it has this nice, clear, shiny box, protective box, so he doesn't slip and, just an elbow hit the button in a bad moment. If there's a button that says go to war, Donald Trump needs the world to truly believe his finger is on that button. Even if the box has never been lifted, he might have zero intention of ever hitting the button, but he needs everyone to think he's willing to. Because if we're convinced that there's no possible way we're going to war, then Iran is sitting semi-comfortably, not even considering a surrender, considering negotiations. They're going to go to war with Israel, and they're going to duke it out. But if there's a fraction of a chance that America might get involved, that's going to lead towards a more likely outcome for a surrender or a negotiation. So it's one of those things that even though I think everyone has your opinion on what's about to happen, and I encourage you, don't be a sheep. Come up with informed opinions. Do some research. Think for yourself. Have takes on what you think the America should do. That's how you become an informed voter and play a part in our democracy of deciding who leads our country. But I also would preach patience and caution with vocalizing too much frustration, because the reality is, in a situation like this, there's no possible way for us to know really what's going on, and we never could have it that way. Let's wait to see how this plays out. Once again, I am an optimist who I really do hope the analogy I just gave is loud and is actually happening. Donald Trump has no intention of actually hitting that button, but he needs the world to think that, to use as much of his leverage as he can to get a deal done. All of my salesmen in the house know this. You never go into a meeting with a client and give them your bottom line price. If you did, you're not a very successful salesman. You probably haven't made that much money. You have to know how to create the art of the deal. Little pun there, because it's a book that Donald Trump wrote, of course. He understands I cannot tell everybody my full intentions. I have to play the game that I hold all the cards, and they've got to come to me. We'll see how this plays out over the next couple of days and weeks, but now it is time, as we're about a minute out, to turn our attention back to Jerome Powell and the FOMC. Here's some things, some closing thoughts as we're kind of wrapping this up, things that I want to hear Jerome Powell speak about. I want to hear a question reference to what does unemployment look like in the future. Number two, I want to hear what is their updated thought about inflation. Is inflation under control, or is there still a fear of uncertainty about what's going to happen in the next couple of months? And then number three, I don't think we can have this press conference and have a real feeling. He might not answer, but I want to see how he responds to questions about what if this war escalates and America is involved. These three questions will tell us a lot about if Bitcoin and crypto are about to go up or if they're about to crash a whole lot further. By the way, he's walking out there. We'll be back to talk about it through after he's done. Let's go to the press conference.
Good afternoon. My colleagues and I remain squarely focused on achieving our dual mandate goals of maximum employment and stable prices for the benefit of the American people. Despite elevated uncertainty, the economy is in a solid position. The unemployment rate remains low, and the labor market is at or near maximum employment. Inflation has come down a great deal, but has been running somewhat above our 2% longer run objective. In support of our goals, today the Federal Open Market Committee decided to leave our policy interest rate unchanged. We believe that the current stance of monetary policy leaves us well positioned to respond in a timely way to potential economic developments. I'll have more to say about monetary policy after briefly reviewing economic developments. Following growth of 2.5% last year, GDP was reported to have edged down in the first quarter, reflecting swings in net exports that were driven by businesses bringing in imports ahead of potential tariffs. This unusual swing has complicated GDP measurement. Private domestic final purchases, or PDFP, as we call them, which excludes net exports, inventory investment, and government spending, grew at a solid 2.5% rate. Within PDFP, growth of consumer spending moderated, while investment in equipment and intangibles rebounded from weakness in the fourth quarter. Surveys of households and businesses, however, report a decline in sentiment over recent months and elevated uncertainty about the economic outlook, largely reflecting trade policy concerns. It remains to be seen how these developments might affect future spending and investment. In our summary of economic projections, the median participant projects GDP to rise 1.4% this year and 1.6% next year, somewhat slower than projected in March. In the labor market, conditions have remained solid. Payroll job gains averaged 135,000 per month over the past 3 months. The unemployment rate, at 4.2%, remains low and has stayed in a narrow range for the past year. Wage growth has continued to moderate while still outpacing inflation. Overall, a wide set of indicators suggests that conditions in the labor market are broadly in balance and consistent with maximum employment. The labor market is not a source of significant inflationary pressures. The median projection for the unemployment rate in the SEP is 4.5% at the end of this year and next, a bit higher than projected in March. Inflation has eased significantly from its highs in mid-2022, but remains somewhat elevated relative to our 2% longer run goal. Estimates based on the Consumer Price Index and other data indicate that total PCE prices rose 2.3% over the 12 months ending in May, and that, excluding the volatile food and energy categories, core PCE prices rose 2.6%. Near-term measures of inflation expectations have moved up over recent months, as reflected in both market and survey-based measures. Respondents to surveys of consumers, businesses, and professional forecasters point to tariffs as the driving factor. Beyond the next year or so, however, most measures of longer-term expectations remain consistent with our 2% inflation goal. The median projection in the SEP for total PCE inflation this year is 3%, somewhat higher than projected in March. The median inflation projection falls to 2.4% in 2026 and 2.1% in 2027. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. At today's meeting, the committee decided to maintain the target range for the federal funds rate at 4.25% to 4.5% and to continue reducing the size of our balance sheet. We will continue to determine the appropriate stance of monetary policy based on the incoming data, the evolving outlook, and the balance of risks. Changes to trade, immigration, fiscal, and regulatory policies continue to evolve, and their effects on the economy remain uncertain. The effects of tariffs will depend, among other things, on their ultimate level. Expectations of that level, and thus of the related economic effects, reached a peak in April and have since declined. Even so, increases in tariffs this year are likely to push up prices and weigh on economic activity. The effects on inflation could be short-lived, reflecting a one-time shift in the price level. It's also possible that the inflationary effects could instead be more persistent. Avoiding that outcome will depend on the size of the tariff effects, on how long it takes for them to pass through fully into prices, and ultimately on keeping longer-term inflation expectations well anchored. Our obligation is to keep longer-term inflation expectations well anchored and to prevent a one-time increase in the price level from becoming an ongoing inflation problem. As we act to meet that obligation, we will balance our maximum employment and price stability mandates, keeping in mind that without price stability, we cannot achieve the long periods of strong labor market conditions that benefit all Americans. We may find ourselves in the challenging scenario in which our dual mandate goals are in tension. If that were to occur, we would consider how far the economy is from each goal and the potentially different time horizons over which those respective gaps would be anticipated to close. For the time being, we are well positioned to wait to learn more about the likely course of the economy before considering any adjustments to our policy stance. In our SEP, FOMC participants wrote down their individual assessments of an appropriate path for the federal funds rate based on what each participant judges to be the most likely scenario going forward. The median participant projects that the appropriate level of the federal funds rate will be 3.9% at the end of this year, the same as projected in March. The median projection declines to 3.6% at the end of next year and to 3.4% at the end of 2027, a little higher than the March projection. These individual forecasts are always subject to uncertainty, and as I've noted, uncertainty is unusually elevated. And of course, these projections are not a committee plan or decision. At this meeting, the committee continued its discussions as part of our 5-year review of our monetary policy framework. We focused on issues related to assessing the risks and uncertainties that are relevant for monetary policy and the potential implications for policy strategy and communications. Our review includes outreach and public events involving a wide range of parties, including Fed Listens events around the country and a research conference that we held last month. We are open to new ideas and critical feedback, and we will take on board lessons of the last 5 years in determining our findings. We intend to wrap up any modifications to our statement on longer-run goals and monetary policy strategy by late summer. After that, we will consider enhancements to our suite of communications tools, including the SEP. The Fed has been assigned 2 goals for monetary policy: maximum employment and stable prices. We remain committed to supporting maximum employment, bringing inflation sustainably to our 2% goal, and keeping longer-term inflation expectations well anchored. Our success in delivering on these goals matters to all Americans. We understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission, and we at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to your questions.
Colby. Thank you. Colby Smith with the New York Times. To what extent has the more limited impact from tariffs at this stage on inflation changed your view on what the ultimate economic fallout will be from these policies and the timing of when they will materialize in the data?
So we've had 3 months of favorable inflation readings since the high readings of January and February, and that's, of course, highly welcome news. Part of that just is that services, core services, both housing services and non-housing services, have really been grinding down toward levels that are consistent with 2% inflation. So that's the good news. We've had goods inflation just moving up a bit, and of course we expect, as you point out, we do expect to see more of that over the course of the summer. It takes some time for tariffs to work their way through the chain of distribution to the end consumer. A good example of that would be goods being sold at retailers today may have been imported several months ago before tariffs were imposed. So we're beginning to see some effects, and we do expect to see more of them over coming months. We do also see price increases in some of the relevant categories like personal computers and audiovisual equipment and things like that that are attributable to tariff increases. In addition, we look at surveys of businesses, and there are many of those, and you do see a range of things, but many companies do expect to put all or some or all of the effect of tariffs through to the next person in the chain, and ultimately to the consumer. Today, the amount of the amount of the tariff effects, the size of the tariff effects, their duration and the time it will take are all highly uncertain. So that is why we think the appropriate thing to do is to hold where we are as we learn more. And we think our policy stance is in a good place where we're well positioned to react to incoming developments.
So in terms of how we should interpret the rate cuts penciled into the SEP, is this reflecting that there's this expectation that underlying inflation will just stay well enough contained that allows the committee to eventually move ahead with those cuts? Or is it about responding to a deterioration in economic activity, let's say? I mean, how should we make sense of the forecast?
So if you look at the forecast, you will see that people do generally expect inflation to move up and then to come back down. But we can't just assume that. Of course, we don't know that. And our job is to make sure, one of our jobs is to make sure that a one-time increase in inflation doesn't turn into an inflation problem. And that, again, that will depend on the size of the effects, how long it takes for them to come in, and ultimately on keeping inflation expectations anchored.
Hi, and thanks, Chair Powell. Howard Schneider with Reuters. If you look at the rate path starting in December to today and adjusted over the full time horizon you've got there, you've taken about a quarter point per year out of your projected path, and you end at a higher rate at end 2027 than you would have in the prior forecast. Is that a result of a sense that tariffs will lead to more persistent inflation? Is it a result of reassessments of where your short-term neutral rate is? Why are you on a slower path now?
So I would focus most on the nearer term. As you get out to the later years, it's hard for anybody to know where the economy is going. You didn't see people moving their longer term, estimate of the neutral rate, for example, at this meeting. So and those things are probably slow moving. So I think if you look at what's happening here since March, this is since March, right? You see a little slower growth, just a tiny tick up, a 1/10 tick up in unemployment, and you see inflation moving up 0.3. And by the way, it was a similar move from the December SEP to the March. So that's what you see. You see the effects of tariffs. I think we learned in April, after the March meeting, that substantially higher tariffs were likely. And then since then, the estimates of where the tariffs will be have actually moved back down, although still at an elevated level. So we're adapting in real time. And what you see is an accumulation of individual assessments.
But you say in the statement that risks have diminished on that front, but the July 9th, drop dead date for all the Liberation Day tariffs is still out there and unresolved. You've got now exchange of missiles between two Middle East adversaries with a possible U.S. involvement. How can you justify saying that risks have diminished?
So what we said was that uncertainty uncertainty about the economic outlook has diminished but remains elevated. Many surveys say that. They do. So, and that's actually a line from the Teal book, which you can see in 5 years. Remember to check that.
Maybe the world will be over.
No, but if you think about it, tariff uncertainty really peaked in April, and since then has come down. And that's really what that's just acknowledging. It's diminished, but still elevated. That it's uncertainty. So I think that's an accurate statement.
Thank you. Chris Rugaber at Associated Press. There is an argument out there in favor of cutting rates more immediately. Inflation has continued to cool and is back to roughly 2% despite the tariffs. And I guess I also wanted to ask about cracks in the job market with gross hiring slowing, concentrated in just a few industries. We've seen some housing data including this morning that have been pretty weak. Do you see any concerns that the economy is weakening and that is a reason to cut rates going forward?
So we do of course monitor all those things. I think if you look at the overall picture, what you're seeing is 4.2% unemployment and an economy that's growing at a rate hard to know given the unusual flows in the first quarter, but it appears to be 1.5%, 2%, maybe a little better than that. Sentiment has come up off of its very low levels. It's still depressed. So you can point to things. The housing market is a longer run problem and also a short run problem. I don't think it's indicative of basically the situation is we have a longer run shortage of housing, and we also have high rates right now. I think the best thing we can do for the housing market is to restore price stability in a sustainable way and create a strong labor market, and that's the best thing we can do for the housing market. You asked about the job market. Again, look at labor force participation, look at wages, look at job creation. They're all at healthy levels now. I would say you can see perhaps a very, very slow continued cooling, but nothing that's troubling at this time. But we watch it very, very carefully. So overall, again, the current stance of monetary policy leaves us well positioned to respond in a timely way to economic developments, and for now, and we'll be watching the data carefully.
Well, just quickly on, given that there are concerns inflation will rise, but there is the alternate scenario that tariffs would create demand destruction and slow growth sufficiently, and that would perhaps keep a bit of a lid on inflation. Do you see odds of that scenario? What kind of odds do you see of that scenario coming true, and how many months of cool inflation would you need to see before concluding that maybe that lower inflation scenario is taking place?
So this is very much the conversation we had today and yesterday. There are many, many different scenarios, many combinations of scenarios where inflation does or doesn't prove out to be at the levels we think, and where the labor market does or doesn't soften. And I think what you see people doing is looking ahead at a time of very high uncertainty and writing down what they think the most likely case is. No one holds these rate paths with a great deal of conviction, and everyone would agree that they're all going to be data dependent, and that you can make a case for any of the rate paths, I think, that you see in the SEP. And we do this once a quarter. It's a hard thing to do particularly at this time, but it does reflect. If you see somebody writing down a rate path that involves cuts, that's them saying, yes, I think we will get to a place, more likely than not, where cuts will be appropriate. And it could be a joint probability of a number of possible outcomes. Again, remember how much uncertainty we face, though.
Thank you. Mr. Chair, I wonder if you could describe for us some of those scenarios. How do you get to a place? I'm noticing that the uncertainty levels in your forecast are very high. How do you get to a place where you have the confidence in the outlook for, say, inflation and or growth or the unemployment rate? How many months does it take, and what do you want to see in the data to get to that level of confidence to actually reduce rates off the restrictive level?
So it's very, very hard to say when.
Why are
that
you
will
punishing
happen. We
Trump?
know that the time will come. It could come quickly. It could not come quickly. As long as the economy is solid, though, as long as we're seeing the kind of labor market that we have and reasonably decent growth and inflation moving down, we feel like the right thing to do is to be where we are, where our policy stance is, and just learn more. And in particular, we feel like we're going to learn a great deal more over the summer on tariffs. We hadn't expected them to show up much by now, and they haven't. And we will see to the extent to which they do over coming months. And I think that's going to inform our thinking, for one thing. In addition, we'll see how the labor market progresses. So at some point, it will become clear. I can't tell you exactly when that will be. And meanwhile, we'll be watching the labor market very carefully for signs of weakness and strength, and tariffs for signs of what's going to happen there. And of course, there are many developments ahead. Even in the near term, developments are expected on tariffs. So I think we don't yet know with any confidence where they will settle out. We have an estimate, and I think all estimates are now pretty close together, but it's again highly uncertain.
When you say estimate of the impact of tariffs on the core PCE, is that what it is? And could you share that?
What you start with is what's the effective tariff rate overall, and people are managing to that. But, you know, the pass-through of tariffs to consumer price inflation is a whole process that's very uncertain. You know, as you know, there are many parties in that chain. There's the manufacturer, the exporter, the importer, the retailer, and the consumer. And each one of those is going to be trying not to be the one to pay for the tariff. But together, they will all pay for it together, or maybe one party will pay it all. But that process is very hard to predict. And we haven't been through a situation like this. And I think we have to be humble about our ability to forecast it. So that's why we need to see some actual data to make better decisions. We'd like to get some more data. And again, in the meantime, we can do that because the economy remains in solid condition.
Nick Tamarosa of the Wall Street Journal. Chair Powell, I guess I'm wondering if you could explain a little bit more the divergence we see in the dot plot, particularly around the 2025 rate projections. I realize this is, you have one group of officials that are putting down no cuts, another that are putting down more than one. And again, recognizing that could be difficult to summarize, but is it a matter of people having a different outlook or a different reaction function, a different commitment to defending against another inflation mistake? How did that play out over the last 2 days?
So you're right. This is often the case. We have a pretty healthy diversity of views on the committee. We did have strong support for today's decision and broad agreement that our policy stance does leave us in a good place. But I would point to two factors, and you mentioned them. The first is just that parties have a diversity of forecasts. And they do align with where their dots are. So if you have a higher inflation forecast, you're going to be less likely to be writing down, more cuts. But remember, as we see more data, we're going to learn more about where inflation is headed, and that means when it is time to look at resuming our normalization process, the differences you see should be smaller because we'll have seen actual data. Right now, it's just a forecast in a very foggy time. So that's the first part, is forecast. Secondly, people can look at the same data and they can evaluate the risks differently, as you know. And that includes, the risk of higher inflation, the risk that it'll be more persistent, the risk that the labor market will weaken. People are going to have different assessments of that risk. So you put that in there too. So those are the two ways that the two things I think that drive these things. Remember though, as I mentioned earlier, with uncertainty as elevated as it is, no one holds these rate paths with a lot of conviction. So that's really where it is. It's a function of those things. And I think as the data come in, you should see those differences diminish.
If I could follow up, you've said that policy is in a good place and that it's modestly restrictive. Given all the uncertainty you just talked about, tariff levels, uncertainty around the pass-through, is it price increases versus margin compression, some of the softness that Chris talked about in labor and housing, why wouldn't it be better to have rates at a more neutral setting as the economy heads into this period of very high uncertainty?
So if you just look backward at the data, that's what you would say, but that's not. We have to be forward-looking, and the thing that every forecaster, every outside forecaster, and the Fed is saying is that we expect a meaningful amount of inflation to arrive in coming months, and we have to take that into account. So I think a backward-looking look would lead you to a neutral stance, but we can't. We have to look at that, and because the economy is still solid, we can take the time to actually see what's going to happen. There's a range of possibilities on how large the inflation effects and the other effects are going to be. So we'll make smarter and better decisions if we just wait a couple of months or however long it takes to get a sense of really what is going to be the pass-through of inflation and what's going to be the effects on spending and on hiring and all those things.
Michael McKee from Bloomberg Radio and Television. Your friend down at 1600 Pennsylvania Avenue continues to lob insults in your direction, and I'm wondering, given now that the Supreme Court has maybe carved out the Fed from some of the legal implications of that, whether this is just noise that the markets and everybody should ignore until your term is up, or whether you worry that it could lead to more pressure on confidence on Wall Street, on consumers, about the outlook for the economy.
No comment.
Look, From my standpoint, it's not complicated. What everyone on the FOMC wants is a good, solid American economy with strong labor market and price stability. That's what we want. We think our policy is well positioned to, right now, to deliver that and to be able to respond in a timely way as the data lead us around. The economy's been resilient, and part of that is our stance. And again, we think we're in a good place on that to respond to significant economic developments. That's what matters. That is what matters to us.
He's
Pretty
got
much
his eye on
that's
the ball.
all that matters to us.
I need to ask, assuming you are not reappointed, would you stay on as governor when your term as chair ends?
I'm not thinking about that. I'm thinking about this.
He's got a country to save.
Thanks, Mr. Chairman. I guess with workplace raids increasing, picking up significantly, what kind of effect would that have on the labor market in
Sorry,
the short
with
term?
what picking up?
Workplace raids.
So you're asking immigration.
Yeah.
You know, I wouldn't want to speculate. One way to get at that from an economic standpoint, we of course don't comment on immigration policy. It's not ours to make or comment on. But what you see is an unemployment rate that has been really solid and at a low level, not really increasing. It's been in a good range and well within the range of mainstream estimates of maximum employment. And that means, like, part of that is that labor demand and labor supply are kind of moving down at the same rate. Labor demand is softening. You see that in job creation, but it's still kind of at a healthy level. And labor supply is diminishing because the immigration numbers that we see are much lower than they were. So those two factors, supply and demand, that's what has kept the unemployment rate in a reasonably stable place.
Okay, thanks. The other thing I wanted to follow up on is if you could elaborate on the potential changes to the SEP that you suggested were part of the framework review, I think.
So the framework review really has two tracks, right? The first track is our policy framework that is reflected in the consensus statement. And we've said that we would finish that and announce it by the end of the summer. So we're well along in that process. We've had the meetings that we need to have, and we're now going to be going into, into discussions about specific changes to language. So that's the framework part of it. The second part of it is our communications tools and practices. Pardon me. And that part comes next. Okay, that's what we're going to do in the meetings this fall. Actually, what we did at this meeting, though, is we sort of prepared the ground for that. We had a meeting where we talked at a high level about a number of ideas. The SEP is part of it. Many other ideas. It's sort of, how do we think our communications can be improved? There are a number of ideas. People offered a really, it was a great conversation, number of ideas, but we're going to look at those with staff briefing and a lot of thought in the fall. And I would say when it comes to changing communications, I would only support things really that only implement things that have very broad support. And also you want to be really careful because I think our communications are pretty well received. They're not broken. So more is not necessarily better, but better is better. So we're going to be looking at ways to do things that will improve the clarity of what we do for the benefit of the public.
Thanks, Chair Powell. Kelly O'Grady, CBS News. You're famously known as the guy that makes decision based on data instead of speculation. You've said today the inflation data is in a good place. We don't know how tariffs are going to impact prices going forward. That's uncertain. But I've got to go back to the last time that you cut rates in December, and there was still the what if of tariffs. So what made you feel comfortable cutting then when inflation was higher than where it is today, and you didn't cut today?
Well, the forecast for inflation in December was 2.5%. Core PCE for 2025, the forecast was 2.5%, which is a good inflation forecast. I think what we've learned is that, and this was long before we had any idea of what the actual policies would be, we've learned that the tariffs are going to be substantially larger than forecasters generally thought. And we don't, our forecasts are generally not particularly different from those of other, well-resourced forecasting operations.
Goldman Sachs.
What we learned, and particularly in April, was that very substantially larger tariffs were coming, and that would mean higher inflation. That's what happened. And so now you see You saw 2.5% forecast in December. You saw 2.8% in March, and you see 3.1% now. So it's 0.6 higher inflation for 2025, and that's a big part of the change, and that's due to the effects of the tariffs that are, we don't know where they're going to land, but it's pretty apparent they're going to land higher than outside forecasters were really guessing at the end of last year.
My follow-up to that, I think consumers, right, we're looking for relief on rates when it comes to mortgages, car loans. Small businesses want to take out more manageable loans. When you look at the cumulative inflation over the past 5 years, prices have risen over 20%. It's been a rough road. So what is the tipping point then for the wait and see approach in terms of how much it's going to help versus when it hurts the American consumer?
Well, I mean, we're trying to restore price. The best thing we can do for the public that we serve is restore price stability. If we can, and we will, restore price stability, meaning 2% inflation on a durable, sustainable basis, that, and also maximum employment. If we restore those things, that's the best thing, and that is our goal. The best thing we can do for the American people, for households and businesses, that is the ultimate thing that we can deliver. And they can make their decisions without having to think about inflation all the time. So in the meantime, we have to keep rates high to get inflation all the way down. They're not very high, let's be honest. I would say policy is modestly or moderately, probably modestly now, restrictive. If you look at the economy, it's not performing as though it were performing under very strict monetary policy, very restrictive monetary policy. So I would say probably modestly restrictive. And so what it will take is confidence that inflation is coming down. Now, I would say without tariffs, that confidence would be building, because if you see what's happening with non-housing services and housing services, which are the other two big pieces other than goods, those are coming down really nicely now. So I think we have to learn a little more about tariffs. I don't know what the right way for us to react will be. I think it's hard to know with any confidence how we should react until we see really the size of the effects, and then we can start to make a better judgment. So that's what we're doing, and I think we can take the time to do that because unemployment is 4.2%. Wages are moving up. Real wages are moving up at a healthy clip now. And inflation is 2.3% headline inflation over a 12-month basis. So it's a good economy and a solid economy with decent growth.
It's an economy to be
Thank
proud
you, Chair
of.
Powell. So you're saying that uncertainty has come down, the economy is moving at a solid pace, inflation has come down over the past 3 months, and this is all moving in the right direction. So are you indicating here that Americans should expect some sort of economic pain in the second half of the year?
I'm not saying that at all. From our standpoint, what I can say is that the U.S. economy is in solid shape. Inflation has come down. The unemployment rate remains at 4.2%. As I mentioned, real wages are moving up. It's a good job creation is at a healthy level. Unemployment, again, as I said, low. Labor force participation in a good place. So, and what we're waiting for to reduce rates is to understand what will happen with really the tariff inflation. And there's a lot of uncertainty about that. Every forecaster you can name who is a professional forecaster with adequate resources and forecasts for a living is forecasting a pretty significant. Everyone that I know is forecasting a meaningful increase in inflation in coming months from tariffs because someone has to pay for the tariffs, and it will be someone in that chain that I mentioned between the manufacturer, the exporter, the importer, the retailer, ultimately somebody putting it into a good of some kind or just the consumer buying it. And all through that chain, people will be trying not to be the ones who pick up the cost, but ultimately the cost of the tariff has to be paid, and some of it will fall on the end consumer. We know that because that's what businesses say, that's what the data say from past. So we know that's coming, and we just want to see a little bit of that before we make judgments prematurely.
And follow up on that. So you spent years ago talking about how you're data dependent, and be a little more direct on this. Now you're making decisions looking forward. Doesn't the data you're seeing today indicate there should be a rate cut?
No, I mean, your monetary policy has to be forward-looking. That is elementary. You've got to be looking. I always talk about the incoming data, the evolving outlook, and the balance of risks. We say that over and over and over again, right? So it's always forward-looking. If at the very beginning of the pandemic, we cut rates to zero immediately. Nothing had happened. We just knew that it was going to be really bad, right? So we took very aggressive forward-looking because we knew things were going to be unusually difficult. So, of course, this is something we sort of know is coming. We just don't know the size of it. And again, the economy seems to be in solid shape. So the labor market's not crying out for a rate cut. Businesses, were in a bit of shock after April 2, but you see business sentiment, you talk to business people now, there's a very different feeling now that people are working their way through this, and they understand how they're going to go, and it feels much more positive and constructive than it did 3 months ago, let's say.
It's a good vibe.
Again, we think that our current stance of monetary policy is in a good place.
Thank you. Amara Mokwe with Bloomberg. Chair Powell, in February, you told Congress that the Fed is, quote, overworked, maybe not overstaffed. Then in a memo to staff in May announcing a deferred resignation program at the Fed, you said you wanted to ensure that the Fed was, quote, right-sized. Those two statements appear to be at odds with one another. Could you explain what changed in the roughly 3 months between those statements that made you decide that staff levels at the Fed should decline?
I don't see them at all as intention. So I was asked, is the Fed overstaffed? And I said no, and I sort of said as a pun, overworked but not overstaffed. People do work extremely hard at the Fed, and I know they work hard at Bloomberg too. So, but we do, we work hard, but I would say this. So we are careful stewards of public resources, and sometimes you need to show that. So there have been several times in our history, modern history, where the Fed has said, you know what, we're going to do a buyout. We're going to show the public, we're going to demonstrate that we are good stewards of public resources. So we thought, and I thought, that this is a time when we can, we grow at about, our headcount has grown at about 1% a year. So over the course of a couple of years, we're doing a careful scrub of the board and all the reserve banks, and we're going to find 10% of employees who can do something else, where we can streamline our operations, and we think we can get there in a couple of years. We think we can do that, and we think this is without taking risk to carrying out our critical missions. So this is something you do very carefully, thoughtfully, and you do it again respecting that we have critical missions to carry out. I've had experience, a lot of experience in my prior careers, with headcount reductions and things like that, and this is how you do it professionally. You do it carefully, thoughtfully, with a lot of planning, and you do it over a period of time. And I think the Fed will be fine. I think no one will notice any decline in our ability to carry out our missions, and I think it's just us wanting to demonstrate to the public that we are actually good stewards of their resources. We're effectively wiping out 10 years of headcount growth with this.
Other than devaluing the currency.
We wanted to show that, that we're good stewards.
How is progress on reducing headcount going so far? Are you on track to meet the goal?
We're just at the very beginning. As you know, we're doing a buyout program. We're gonna hit that goal. I think many organizations find that they can do this. You don't want to do it every year or anything, but you can do it at intervals, and you wind up not interfering with your ability to perform your jobs.
They're reorganizing the janitor closets.
Chair Powell, Claire Jones from the Financial Times. As you're no doubt aware, the Senate Finance Committee has tabled its version of the reconciliation bill this week, and I was wondering if you could tell me a little bit about the tenor of the debate at the FOMC over the past few days on fiscal policy and the degree to which that influenced people's projections for 2026 and beyond. Thank you.
She was wondering.
We don't sit around and debate or really discuss. We take fiscal policy as fully exogenous, and so we actually, really didn't talk about the bill or the contents of it. It's still evolving. When it gets closer, remember also we have a very, very large economy, and that the effects will be at the margin, I expect that they may already be in, but they will be in by the next meeting. We'll make an estimate, but it's not a major thing. It's nothing that we discuss. It may have been mentioned a couple of times, but as something that's coming in. But I think the outcome is, we don't know the outcome yet there, so hard to be real specific.
Neil. Thanks, Chair Powell. Neil Irwin with Axios. There have been some cutbacks in economic statistics collection in the last few weeks. Worries that long-running problems around funding and response rates may be getting worse. How much is this concern on your radar? How much confidence do you have that the gauges you're watching to assess the economy are reliable right now?
You know, two things. One, the data we get right now, we can do our jobs. I'm not concerned that we can't do our jobs. That's not the point. The point really is that we are starting to see layoffs and important gatherers of data are saying that they're having to cut back on the size of their surveys. That's going to lead to more volatility in the surveys. I think we should take a step back and, from our standpoint, and I think the standpoint of businesses and governments and everyone, having really good data on the state of the economy at any given time is a huge public good. It helps, it not just doesn't help the Fed, it helps the government, it helps Congress, it helps the executive branch. More importantly, really, it helps businesses. They need to know what's going on in the economy. The United States has been a leader for many, many years in this whole project of measuring and understanding what's happening in our very large and dynamic economy. And I hate to see us cutting back on that, because it is a real benefit to the general public that people in all kinds of jobs have the best possible understanding of what's happening in the economy, and
maybe if you cut rates, Jerome, you could afford to keep the people on.
What's going on in the U.S. economy? If you read, there was a book called
Mute him real quick.
It's really remarkable how
because this is a dumb answer. He's giving a long dumb answer. Didn't he start this whole press conference off by saying that unemployment levels are great and that we're at max employment levels? And yet he's saying the companies they use to survey people to find their data can't afford to keep people. They have to let people go. So is that not an oxymoronic statement that even the companies he uses to collect the data to make the decisions can't afford to keep hiring people? They have to let people go.
It sounds like it.
We're conducting this monetary policy strategy framework review. But next year, we're supposed to have a new Fed chair. And I'm wondering if that affects at all the way that you're approaching this. How do you ensure that this framework will actually be durable?
The framework document goes back to 2012, and it's the committee's document. It's not like we're going to invent a brand new way to do things. It's been an evolving document, so it shouldn't depend on who the chair is at all. It should depend on what's happening in the economy and what the committee wants to do. So, yeah, it isn't really tied to any particular chair. And we used to renew it every year. Now we do it every 5 years. So, but I don't think I've never heard anyone raise this issue that, a new chair might want to come in and go in a completely different direction. I really don't think that's right. But but that's not going to be up to me to decide.
Is that affecting at all who you're consulting with?
Not at all. Not in any way.
Thank you. Chair Powell, Matt Egan from CNN. Relatively low gas prices this year have helped drive down inflation in recent reports, but that trend is starting to reverse given the crisis in the Middle East. How are you thinking about how the Israel-Iran conflict will impact the economy, especially inflation? And what lessons were learned during the 2022 period when another conflict, the Russia-Ukraine war, sent oil and gas prices skyrocketing?
So, of course, we're watching, like everybody else is, what's going on. I really don't have any comment on that. Possible that we'll see higher energy prices. What's tended to happen is when there's turmoil in the Middle East, you may see a spike in energy prices, but tends to come down. Those things don't generally tend to have lasting effects on inflation, although, of course, in the 1970s, they famously did, because you had a series of very, very large shocks. But we haven't seen anything like that now. The U.S. economy is far less dependent on foreign oil than it was back in the 1970s. So, but there.
A quick follow-up. I've just got to ask you about artificial intelligence. Some technology executives have recently been warning that AI could wipe out a large chunk of entry-level jobs and significantly increase the unemployment rate. I'm wondering how concerned you are, if at all, about the threat that AI poses to employment.
So this is the question. question really is, will AI be more augmenting labor or replacing labor? And I wouldn't, we all see those announcements, including one today. I wouldn't, overread a couple of data points, because, AI should be creating jobs at the same time. It may be replacing, maybe doing both. Anyone who's done any work with it, with AI, will have been a little bit stunned at how capable it is. And it's just a different thing. So I think this is something that certainly has transformational potential. And probably we're in the very early stages of it. They say what you're seeing now compared to what you'll see in 2 years is going to be very different and even more effective. So I think it's really hard to know. Of course, there are optimists who feel like it's going to make everybody much more productive. And there are those who think it's going to replace an awful lot of jobs right across the income spectrum, white collar, blue collar, and everything. So I just don't know. We don't have a house view on that, but this is going to be a very important question for some time.
Agreed.
Greg.
Thank you. Greg Rapp from MarketWatch. I was wondering if you could step back a little bit, Chair Powell. There's a spate of articles and a lot of op-eds now in the newspapers saying that the U.S. economy and the global economy is going through this profound change, akin to the end of the Bretton Woods era in the 1970s. And don't you owe the American people some sort of explanation for what we're going through? I mean, I noticed earlier this month when you talked about Bretton Woods a little bit, and you said that Bretton Woods, the Fed staff had to change how the dollar, movements of the dollar was impacting the economy. Are we going through something like that now? That, are you having to change how you do monetary policy? Is it that fundamental a change underway? Thanks.
It's certainly a time of real change. From a geopolitical standpoint, from a trade standpoint, from an immigration standpoint. You see this not just here, but everywhere. So there's quite a lot going on. It doesn't change the way we do monetary policy in the near term. And it doesn't change our objectives or what we need to do. And, these things are not really our issues. They're really issues for elected governments. All of those issues are really for elected governments. But there's no question it's a time of real change, and very hard to see where that goes. Will it be, there have been many things written about how it's going to be a more inflationary time. That's possible. It's not guaranteed. AI could cut in the very other direction. AI could make people much more productive and push in the other direction. I don't know, though. But you're right. But honestly, our focus is a much more practical one, and that is, how do we keep inflation low and employment high in the near term? That's really what we're about.
Mark.
Hello, Chairman Powell. Mark Hamrick with Bankrate. What is the view about the growing amount of slack in the job market, including the softening in payrolls, the forecast of a modest rise in the unemployment rate, and the ability of workers to demand wage hikes or not in this environment where you have inflation surging?
You don't really see unemployment going up. You don't see increased slack, really. At the margin, remember, you're at 4.2% unemployment. That was, for many years, that was a extremely low level. It happens to have come up off of an even lower level as we came out of the pandemic. We were as low as 3.4%, but 4.2% is probably at the low end of estimates of the longer run, sustainable level of natural rate of unemployment. So I guess I wouldn't agree with that. And also, in terms of wages, real wages after inflation have been moving up sort of more than was consistent with 2% inflation. They're still moving up at a healthy clip, and I think much more consistent with 2% inflation given a reasonable assessment of trend productivity. So it's a pretty good labor market. You're right that the level of job creation has come down, but so has the supply of workers, the change in the supply, the new supply. So you've seen the unemployment rate remain pretty stable at 4.2. It's been as high as 4.3, but those are good numbers. So it's a pretty good labor market. There's a more concerning thing is There are not a lot of layoffs, but there are not a lot of job creation. If you're out of work, it's hard to find a job, but very few people are being laid off at this point. So that's an equilibrium we watch very, very carefully, because if there were to be significant layoffs and the job finding rate were to remain this low, you would have an increase in unemployment fairly quickly. But that hasn't happened. It really hasn't happened. The U.S.
so
economy
dumb.
has defied
Oh my
all
gosh.
kinds of forecasts for it to weaken, really, over the last 3 years. And it's been remarkable to see just again and again when people think it's going to weaken. Now, eventually it will, but we don't see signs of that now.
Go to Jean for the last question.
Hi, Chair Powell. Jean Young with MNI Market News. There's been a lot of talk about cuts. I wanted to ask you, why do you think there are no forecasts for rates to rise or even to stay where they are next year, given that the projection for inflation is to rise to 3%, and there's a lot of there's some skepticism over whether those price hikes will be a one-time event?
So there are a number of people on the committee who wrote down no cuts this year, but some cuts next year. So, I think, people are writing down their most likely path, right? They're not saying there's zero possibility of other things. Really, think of it as the least unlikely path in a situation like this where uncertainty is very high. I think, again, people write down their rate paths, and they do not have like a really high conviction that this is exactly what's going to happen over the next 2 years. No one feels that way about their rate path. They feel like, what am I going to write down? I mean, what would you write down? It's not easy to do that with confidence. So I would just say it that way. We don't rule things in or out. Certainly a hike is not the base case at all. It's not something people are writing down. But in the meantime, we do the best we can with these forecasts, and I think they're representative of the different forecasts and different reaction functions that people on the committee have. So thank you very much. Thanks.
There he goes.
Great song. Great song. Again, there are some really stupid takes, I think, in this one. I'm asking you, Tshroom, because maybe I'm just dumb, right? There's a very high likelihood I'm just being dumb about this. How do you feel good about the future of unemployment levels when your statement shortly after is, well, if you're unemployed, it's really hard to find a job, but nobody's laying anybody off? The whole concept of a growing economy is people get let go from this job, they go get another job, people change jobs. But he's pretty much saying we're not losing a lot of jobs, but we're not creating new ones either. That is a recipe for mass unemployment. As companies get down to their last couple of dollars because they can't take out a business loan and do some mass layoffs, I don't know if you can pull up the unemployment chart. It's never a slow trickle. It's almost always a flat, nothing's changing, and then out of nowhere, it goes nuts. Can you pull up an unemployment chart from your end, and let's take a look at some of the times where things have skyrocketed, what it looked like in the weeks and months beforehand. And again, it's that concept, like if there's no new jobs, if people who don't have jobs cannot get new jobs, that is a sign of a stagnated economy where nothing new is being created. Yeah, look at this. Look at these spikes. It is never a slow, multiple month long process to get out of control. It is hey, we're doing good. Oh my God, we got really high unemployment all of a sudden out of nowhere.
Yeah. So it's, just to kind of echo that, it's like improvement, and then skyrocket, right? Improvement, huge move, improvement.
I mean, look at that one. Like,
huge,
that
was the pandemic, right? So, we're in a little bit of a different situation here where it's actually a slow uptrend.
It's a slow
versus
burn,
a slow downtrend. But anything can happen. He was asked the question about AI, and his answer essentially was, we don't have a house opinion on that.
Yeah.
That's an interesting way to put that. That means that they have discussed it, but it's not something that they've reached a consensus on. It almost feels out of their scope because it's such a technological question. But he clearly has shown that he's done some reading on this, saying that AI will create jobs as well as reduce jobs, and whether it will modify employment rather than reduce employment. So he has some thoughts on it, but it's not something that they've reached a consensus on. I think that the Federal Reserve, given their dual mandate, should be all over this. They should be hearing press briefings they should be getting briefed by Sam Altman, by Sundar Pichai, like weekly on what, getting forward guidance on what this AI technology is looking like and how it's replacing workers. They should be getting official briefings on that. And those briefings should probably be made public. The fact that he's comfortable saying that they don't have a House opinion on it, it's like he's way behind the 8 ball per usual. And I don't believe that the Constitution affords Donald Trump the ability to fire Jerome Powell or the chairman of the Federal Reserve, but he's definitely not going to reappoint him. And Trump will probably be appointing a overly dovish new chairman to the board, and will probably have a very stern and possibly public finger-waving session with the rest of the board, because the rest of the board, I don't think, can overcome or they can overcome the vote of the chairman. I don't think it's the chairman just gets, it's not his, he's not a king, right? He has the board has a vote. But yeah, the ultimate question there is a good one.
Brillo said, those are just recessions. No. Well, the thing is, Brillo, you got to think about what is a recession. A recession is a period of time with a really diminished economy. One of the biggest signs of a recession, of course, there's the classical definition of two consecutive quarters of negative GDP. But what almost always corresponds with that is businesses. You have negative GDP because businesses are producing less. And when you're producing less, you fire people. There's a little bit of a which comes first, the chicken or the egg, but recessions can cause a spike in unemployment, or a spike in unemployment can cause recessions. They go very hand in hand. So if you look at that chart like that, that's what that's going to show.
Yeah.
I want to give my overall take. I wanted to respond to something good old CNN wanted to point out. Good old CNN. I don't think CNN looks at charts when they make questions. Overall, my takes on this press conference, I really did, I kind of vocalized it during it, a lot of hypocritical moments, maybe. I don't know if hypocritical is the right word. Oxymoronic moments. Unemployment's great, but hey, by the way, the way that we make our decisions by collecting data based off of surveys and other things, yeah, those companies are laying people off. Unemployment's a little, hitting them pretty hard, but everything's okay. We just will have less good data to make informed decisions on. That didn't make sense to me. He says that, the whole thing they started, the report they gave early about stagflation is no longer a concern. And yeah, there's uncertainty about tariffs, but as he even said, it's like, oh, well, tariffs aren't as bad as what we originally thought, but we're still unsure of what the future looks like. Well, of course, everyone's unsure about what the future looks like. But you guys acted like we were going to, the tariffs are going to make us fall off a cliff, and we didn't. And that kind of leads me into what the CNN reporter kind of said that I thought was kind of stupid. Because again, I told you guys before, and I wanted someone to ask him what his opinion was of the war. And the reality is Jerome Powell didn't really respond to the question. I'm kind of more going to help you guys understand it. The CNN reporter, he asked, so far gas prices have remained low because oil prices have been low this year. But if this war repeats like Russia and Ukraine and skyrockets in oil prices, what are we going to? Isn't that going to massively affect inflation? Also known as CNN reporter wants to point out that gas is going to get terrible, and the one good thing under the Trump administration that people can't really argue with, gas prices being low, he wants the war to cause higher prices so that Trump looks bad. I was doing some investigation here. I was looking over here, but let's go over here. The war between Russia and Ukraine. Russia invaded Ukraine in February of 2024, February 24th. 2024. I'm on the weekly chart, so I'm going to show you the week that encompasses this. But this, ladies and gentlemen, this right here, this big white candle, yes, this is oil, the week that Russia invaded Ukraine. What do you notice beforehand, though? The majority of oil prices were rallying months. Look at these months between December, it's a month and a half, 2 months. Between early December and late February, so we're talking about 3 months, we were already rallying before any invasion. You go back before that, the trend was ridiculously high. If you go back all the way to COVID, of course, big crash, starts to come back up. But oil prices were going very, very high for months before this situation. When you actually look like it, the week that Russia invaded Ukraine, yes, we had a massive spike in the price of oil in that week. We saw oil rally 24%. If you include the 2 weeks, it rallied 39% those 2 weeks. But this marked the top of oil. And I mean, unless you guys know something I don't know, I don't think the war between Russia and Ukraine, I could be wrong. I think it's still going on. And when I say I think, I mean I know, because it is, because people still talk about it all the time. The worst of it was over in 2 weeks. And since that time, oil prices have been dropping despite the fact that war is continuing. So I say all that just to kind of clarify for CNN, war might have given a little bit of a kick to end the spike in oil, but oil prices since that war have gone on and actually come down. I just continue, this is a very classic composite man move to take two dots and create a connection between the two dots. You can go off my screen here, Tshroom. Connect the dots in a way that makes sense, that confuses the retail investor. What am I saying here? Dot one, Russia is heavily involved in oil prices. Guess what? One of the reasons why is because their relationship with countries in the Middle East, like Iran. Iran's very heavily involved in oil prices. Iran goes to war. Logically, shouldn't we just connect the dots? Oil prices go up. Shouldn't that line just connect very easily? Of course it should connect very easily. So retail investors freak out because when oil prices go up, all of your goods and services will skyrocket in price. Makes so much sense until you look at the reality of how these things worked. I was playing with Grok earlier. I was telling Tshroom, but I was going to tell you guys as well. I was playing with Grok, and I was like, okay, what does war usually do for inflation? How does inflation react to war? And Grok's first answer it pops up was, oh, yes, war will cause a spike in inflation. For example, in 1945, so it went all the way back to World War II, it talked about the spike in inflation when we were providing for war. But then I said, okay, what about in the war of Vietnam? Inflation went down. What about the war when we invaded Afghanistan and then Iraq in the early 2000s? Oh, it just stagnated right around 2%. So it's easy to say, hey, guys, prepare for high oil prices. Hey, guys, prepare for high inflation because I can connect these two convenient dots that makes logical sense when in reality is if you study your history, wars don't necessarily bring higher inflation. Wars don't necessarily always bring an increased price to oil. And I know there's a lot of things that play into it. I'm just saying, if you study your history and you understand how markets are manipulated through the news, through sentiment, through discouraging the average retail investor, it's an encouragement to say, you know what? The markets might not be as easy as what they're trying to make me believe. And if the mainstream media is trying to scare me and convince me to sell, odds are the reason why is because something good is actually about to happen and they don't want me to be a part of it. They want to buy the dip themselves. They don't want me to be in. I'm going to leave it right there with my thoughts on this whole thing. Again, this meeting did not go the way I thought it was going to go, the way I hoped it was going to go. I mean, Bitcoin didn't go berserkly to the downside. We're still hovering above 104,000 at the moment, but it was not a potential glimpse into a rate cuts coming. In fact, I think something he said pretty early on was that their expectation of where rate cuts will be at the end of 2026 is actually higher than what their expectations were last month. What that means is I still think all of them think there are rate cuts coming. And at this point, we're still predicting a September rate cut, but they're saying there's going to be less cuts between now and the next 18 months in expectation than the expectation was last month. That technically is hawkish, which would be less liquidity, which people should respond by selling off. But again, with all the uncertainty talk, I still lean towards, I think that there's a lot of scare tactics right now out there And we'll have to see how the next 24, 48 hours kind of progress with this market.
Yeah, let me give you my take as well. But before I do, let me share a little bit about who's making this live stream possible. It's Kinesis.money is our partner. You can find a link for them down in the description. They store it. You own it. They're referring to gold, precious metals, independently audited. They actually will take delivery of your gold at any time. So you can get your gold or silver delivered to your residence at any time. World-class, fully insured vaults. And you actually can earn a yield on the gold that you own through Kinesis. If you held your gold with Kinesis in May, the monthly yield could have earned you 11.76% annually. So this is why we've partnered with Kinesis. We really like what they do, and it's also an excellent low-cost on-ramp for crypto to turn your fiat into Bitcoin or Ethereum or many other. I think they have 50 to 70 altcoins in addition to Bitcoin on their platform. So Kinesis is who we partner with. Jump down into the description below to click the link, check them out. A lot of people have done this, by the way. We've partnered with people in the past, and we get no clicks on the link because people aren't interested in what they have to sell. Kinesis is different. Hundreds of people have gone down, clicked, and many of them have signed up because they see the value in Kinesis. So thank you so much, Kinesis, for making this happen. There they are right above us. My view on this is that this was productive. I think that Jerome Powell, he really played the line. That's what we were expecting him to. And he did lean hawkish, right? But we were expecting that. He's been getting so much thrown at him from the White House. Not just Trump, but also J.D. Vance chimed in earlier this week, kind of putting pressure on the Fed. So if you kind of correct for that, Jerome Powell was actually playing the middle, right? Which shows that there could be some cuts later this year, and it's not just me interpreting that. We also see that here from Polymarket, now pricing in a 43% chance of a cut in September. This was as high as 46%. You can see over the last hour, since this is right around here is where Jerome Powell would have gone live, right around 4:30. You can see that the red line got up above the blue line and then came back down and now is back down below. But that red line represents a cut in September. Okay, so there was productivity. There was a productive kind of movement in the betting markets for how we could see the rates decision go in September. In July, not so much. There really wasn't anything productive there. In fact, the cut gave up 11% ground, right? So July, probably another foregone conclusion. They skip August, just in case you're new to this. They skip August. They go back in September. Again, right now, there's been very little productivity, but it was overall productive for the betting markets. I don't think that gets us very far, though. And my ultimate kind of takeaway from this is that this was a bit of a nothing burger. We didn't learn a whole lot. What we did learn wasn't very encouraging, which is that the Fed is totally behind the 8 ball yet again. But now it's on the behind the 8 ball on something that's a lot more important, which is how AI could affect unemployment. That was not something that I was expecting a question to be asked, but it was. And Jerome gave a very poor answer of we don't have a house perspective on that. I think that, again, I'll reiterate what I said earlier in the stream. I think they should be getting briefed every day by Sundar Pichai, Jeff Bezos, Elon Musk, anybody that has a perspective and will lend their brief to Jerome Powell and his board there should be. That should be happening weekly, if not daily, because that is such an important impact on the future of not just the United States unemployment rate, but the world. It's very, very important. And they're not interested in really helping the people. I think they serve a group that is north of Richmond and a group that is in Wall Street as well. So that's my final assessment. They didn't signal that they're really interested, saying that they're not crying out loud enough. We get the labor market is not crying out for a rate cut, says Powell. I don't know. I feel like if the labor market was educated enough to know how the Federal Reserve debases their currency, they would be crying out for a rate cut. So it's pretty wild times. But overall, I'd say that this was right down the middle. It was somewhat dovish if you account for the amount of pressure that the Fed is under to cut, right? Maybe I'm being too optimistic there, a little too courteous. But that's kind of my interpretation. I think it's a nothing burger. I think that Bitcoin is much more concerned. I think risk assets investors are much more concerned now about what is going to happen with this conflict in the Middle East. And then once that is resolved, and if it isn't resolved or it kind of smolders down to a manageable level, I think what is going to be in focus is the BBB, the Big Beautiful Bill. That is going to be very, very big. We are not yet in that news cycle, but that is coming very quickly. I think the market will refocus its attention on trade talks with China and trade talks with other countries. Japan really was the first to come in and start to make a deal. Haven't really heard hide nor hair of how those trade talks are going. Not a great sign. But hopefully we'll continue to see productive talks with other major trade partners of the United States. And of course, watching productive movement in predictions for September rate cuts is the big one in order for the Russell small cap stocks and crypto altcoins to start to see a bid and reach that euphoric phase of the altcoin cycle we saw in 2021 and we saw in previous cycles. So that's my overall assessment, and I really want to thank you all for tuning in, for watching. This has been a great time. Maybe not the most stimulating Fed meeting that we've seen, but it was good to get this behind us. The market now has some certainty. It's not some very sweet certainty. It's a little bit more bitter certainty, but it's certainty nonetheless.
Yeah, I'll say this. It's one of those things that, will I say this was most entertaining and greatest FOMC meeting ever? No, there's been some that actually I found very interesting. But honestly, we got to watch them. We got to pay attention, because if something good is said or extremely bad, you want to be aware. So we encourage you, even with the ongoing uncertainty, for lack of a better word there, I'll use Jerome Powell's, with the uncertainty ahead of us, lock in. Whether you're invested, whether you're looking for a good entry into the markets, the best way to know how is to stay updated with all the information coming out on a daily basis. That's why we are a channel here. That's why we have a daily Q&A, live trading, news updates, all happening in our Discord with our VIP trading group, is because we understand if you want to make money, you got to stay up to date daily with what is going on. Whether the market's going up or down or sideways, there's always a way to make money. Go find out a way to do that over in that VIP trading group. That's all we're going to have for you guys today. On your way out, we had over 1,000 people live here on YouTube, another 1,000 over on X. Smash the like wherever you are. Follow me on X. Follow the Investing Bros on X. Subscribe to the YouTube channel right here. I'll see you guys over in the Discord here shortly. We'll be talking some trades for the evening. The rest of you, will see you next week. Adios.